we are making these transitional measures only to be applicable to insurers, whereas maybe the IFRS standard is applicable to all. But our rationale was that historically, we normally make transitional measures only to the insurers as they are the ones that are affected mostly. So after the budget, we had meetings with both the short-term and long-term insurers. During the public consultation, we were told that in terms of the short-term, the impact will be minimal, in some instances, zero. However, on the long-term insurers, the impact may be sizable, but it depends on insurers. As such, we made changes to the legislation, and our proposed changes are blanket because we're not going to choose. So we did take their comments and we went back, whereby we have to make the changes that are broader and applying equally to everyone. So in order to limit the impact, these are the changes that we are proposing. First of all, this is the easy one, whereby we'll align the definitions and terminology of IFRS 4 to IFRS 17. And then the big one is the introduction of the transitional tax measures, so as to limit the impact of the phasing in. Next slide. As indicated, based on the discussions, the impact felt by the short-term insurers is minimal to nil, whereas the impact felt by the long-term insurers is sizable. As such, the proposed changes in terms of the phasing in period will differ based on the impact. With regard to the short-term insurers, we are proposing this, a phasing in period of 3 years, whereas with the long-term insurers is the phasing in period of 6 years. And then what will be phased in during this phasing in period? We have what is called the phasing in amount. In terms of the short-term insurers, it will be the difference between the amount that is deductible from income of a short-term insurer in terms of the current provisions of Section 28.3 and 28.3A of the Act at the end of the year of assessment, commencing on or after 1 January 2022, but before 1 January 2023, determined under the current rules of the Act, and the amount of deduction for the measuring year had IFRS 17 been applied at the end of the measuring year. It is important to note that these two, the phasing in period and the phasing in amount, will be the contentious one during the public hearings, because this is where the gist is. With regard to long-term insurers, the phasing in period in this regard is 6 years. And the phasing in amount will be the difference between the adjusted IFRS amount determined under the current rules with reference to IFRS 4 at the end of the year of assessment commencing on or after 1 January 2022, but before 1 January 2023, and the adjusted IFRS value amount had IFRS 17 and the definition of adjusted IFRS value as amended by the 2022 TLAB been applied at the end of the year of assessment. Thank you. The next one is international tax. Next slide. Clarifying the deeming provision in respect of royalties derived by CFC. The Income Tax Act contains controlled foreign company corporation rules, controlled foreign company rules, whereby they are anti-avoidance rules that are aiming to tax the income of South African residents who are holding more than 50% of the shareholding in a foreign company. And the income is taxed as when it is earned. And the calculation of the income of that foreign subsidiary is calculated as if the income is a South African company. The most important rule contained in the CFC provision is that the net income of the CFC must be calculated as if the CFC is a taxpayer for South African tax purposes, and in some instances as if the CFC is a resident when applying certain provisions of the Act. For example, a CFC is deemed to be a resident in relation to interest derived from a South African source. However, the CFC provisions does not mention how the royalties derived by the CFC should be treated. So this is an oversight. In order to correct this oversight, it is proposed that the deeming provisions for Section 92A be extended to cater for royalties. Next slide. Clarifying the treatment of amounts from hybrid equity instruments deemed to be income under CFC rules. The CFC rules contain an exclusion applicable to a payer and payee for intra-group interest, royalties, rental income, insurance premium, or income of similar nature, provided both payer and payee are part of the same group of companies. One important aspect of the CFC legislation is that there is what is called tainted income, which is more of passive income. And the reason why the passive income is taxed is that in terms of the international tax principles, we see no reason why you have to go and establish a foreign subsidiary, whereas you'll be investing in passive income. And the rationale for that is that you could be investing in passive income even if you are here in South Africa. So the passive income of a CFC is regarded as tainted income and taxed immediately. However, there is an exclusion if the income is paid by both the payer and the payee are part of the same group of companies, which is a similar exclusion as what Lerato was saying, whereby we afford a deferral of tax or an exclusion in terms of corporate reorganization if both companies form part of the same group of companies. In terms of hybrid equity instrument rules, certain dividends in relation to the recipients are deemed to be income. To ensure tax neutrality in this regard, it is proposed that specific reference be made to the exclusion of the payee companies deemed income for hybrid equity instruments between the CFCs. So this is more of a technical correction, but we have already received comments in this regard because we thought that this is a small change, but we will deal with the comments during the response document. The next slide. Draft TLAB tax incentives. I will hand over to Haley because the two proposals dealing with the assessed loss restriction and Section 23M interaction with mining companies, they flow from the corporate rate reduction from 28% to 27%. So they are part of the broad-based measures. Over to you, Haley. Thank you.
Thanks, Yanga. All right, so as Yanga mentioned, these were almost sort of consequential amendments. So we had an assessed loss restriction rule that had a sort of weird interaction with our current mining legislation. So we proposed to restrict the use of assessed losses carried forward as part of the corporate income tax package. And as you'll remember, this was to broaden the tax base and reduce the corporate income tax rate. And because of this anomaly, we're just trying to clarify how this should interact with the mining legislation. If you can go to the next slide, Chris. Thanks. All right, and then we also had a similar difficulty with respect to the interest limitation rules that we were strengthening. So you'll recall that we were strengthening these rules in respect of debts owed to persons that are not subject to tax as part of the corporate income tax package, and this was also part of broadening the corporate tax base, which enabled the lowering of the rate. And again, here we discovered an anomaly with how these rules interact with respect to mining operations. And so we're basically proposing to clarify how these rules should interact with one another. Thanks very much.
The next one, over to you, Lerato.
Okay, thanks, Yanga. Okay, so the last one under the incentives is the tax treatment of an asset acquired as a government.
Can you put on your camera? Just to all those presenting, if they can, just put on your camera if you can, just for the record.
I've actually really pressed it because Yanga even told me I had every intention of putting it on, but I don't seem to be coming on. It's like, you come see what's happening here?
That's fine. Carry on.
Okay.
There's a problem.
So while it just hovers about it, I'll just keep talking. So essentially, we have a regime that caters for government grants. So all government grants are governed by these provisions under 12P, and it works along with the 11th schedule. So under the regime, you basically have the exemption of government grants. As a taxpayer, if you receive a government grant, that amount is exempt from tax. However, what happens within the regime is that when you have received an amount and then you use that amount to say acquire an asset or fund your operations and so forth, you no longer have tax attributes. So you don't have your cost is not recognized because you're not incurring the cost. The government is actually incurring the cost for you. So you will not get access to the normal deductions that you get under the tax regime. The problem comes in with government grants in kind. So in the instance where, okay, somebody's sending me a message. Okay, what happens then with government grants in kind is that you then have an instance where there's a slight difference in the tax treatment, which results in an anomaly that when you receive the actual asset and not the funding to acquire the asset, the current provisions don't talk to you no longer having those tax attributes, especially when dealing with 11E, the wear and tear regime, because under the wear and tear regime, they don't look at cost, which you wouldn't have because you didn't incur the cost to acquire the asset. You just acquired the asset as a government grant. Under Section 11E, they look at the value of the asset. And when you receive the asset, it's a valuable item, so it has value, and then you get access to the wear and tear allowances, which has a double dipping effect on the fiscus because you receive an asset for free from government, and then you also get access to deduction under the wear and tear allowances. So this amendment seeks to make the correction under 11E that if you receive a government grant, you do not get access to the wear and tear allowances in respect of that asset that you received as a government grant. Thank you.
Okay. The next item on the agenda is VAT. Anissa will join us as and when she's available because she's at the doctor's room. So I don't want to put pressure on her, but this is her specialty as she prepared this part of the presentation. With regard to the VAT, the proposals that are there, of which they are more contentious, is reviewing the Section 72 decisions. What happens is that in 2019, changes were made in Section 72 of the VAT Act, which deals with the commissioner's discretion to make decisions. And that change had an impact on the rulings that were made on VAT before 21 July 2019. So over the past 2 years, we have said that we will be looking at which rulings can we turn them into the law, and we put them into the law. This implies that some of the rulings will be done away with and may not be turned into law, but some of the rulings may be turned into law. So over the past 2 years, we've made some of the changes, and also in the 2022 draft TLAB, we are proposing to make some of the changes in the legislation to change some of the rulings into law. Next slide. The first one is reviewing the Section 72 decisions dealing with cross-border leases of foreign-owned ships and aircraft. In 2020, we made changes to the VAT Act to the definition of enterprise in instances where the lessee imports the following goods, namely ships, aircraft, and rolling stocks for use in South Africa. So what happens is that we said that when the lessor leases these and they are foreign owned, they're not going to be regarded as if the lessee is carrying on an enterprise in South Africa. So it has come to government's attention that the new provision that has been made does not extend to apply in instances where the foreign lessor enters into a separate agreement with the South African resident lessee for purpose of leasing any foreign-owned parts. What was brought to our attention was aircraft engines, because they said that with aircraft, you can lease the engine of the aircraft. So in the 2022 draft TLAB, we are proposing to make changes to say that if the foreign lessor is leasing an engine of an aircraft or a ship or a rolling stock and some of other parts, then that will not be regarded as carrying on an enterprise in South Africa. Next slide. Next slide, yes. The second one is reviewing the Section 72 decision regarding with the VAT treatment of flash title sales. One of the decisions made in terms of Section 72 was the one dealing with the VAT treatment of flash title sales. A flash title is defined in the export regulation as a supply of movable goods by a vendor to a non-resident qualifying purchaser, which is QP1 in terms of the export regulation, of which QP1 will subsequently supply those goods to QP2 for export. So the issue is the goods, even though they are received in South Africa, but they are not meant to be used or consumed in South Africa. As such, a ruling was issued to say that with regard to flash title sales, the acquirer of the goods on a flash title basis does not have to register for VAT in South Africa. So now, in view of the fact that the decisions will no longer be valid after 31 December 2021, we are proposing to make changes in the legislation so as to change that ruling into the law. Next slide. Next slide. Yes. Regarding documentary proof, Chris, slide 44. Sorry about that. Yes. So this one deals with the evidence for repossessed goods. So when goods are under installment credits, are repossessed, the VAT Act deems the repossession to be supplied from the borrower to the debtor to the lender in order to permit the lender, who is the registered vendor, to recoup some of the output tax paid at the outset of the installment credit sale. So for example, if the car is repossessed, then it will go back to the lender. So the supporting documentation for this input tax adjustment is the invoice or VAT declaration, which is signed by the debtor. So it has been brought to our attention that by that time, if the goods are repossessed, it will be difficult for the lender to get the debtor to sign that VAT declaration because the relationship between the lender and the debtor is no more. So as a result, the commissioner before 21 July 2019 issued a ruling to say that the signature is not required in these instances. So because the ruling will expire on 31 December 2021, we are making changes to the law to say that in instances where the goods are repossessed, the declaration need not be signed by the debtor, but we are inserting other special conditions to that effect. Next slide. The VAT treatment of registration of certain foreign suppliers. The VAT Act, everything in the VAT Act falls under the definition of enterprise in Section 1. So the definition of enterprise in the VAT Act, read together with the provisions of Section 23, make provision for every person who's conducting an enterprise and whose taxable income has exceeded the registration threshold to register in South Africa as VAT. This applies even if such vendor does not have physical presence in South Africa. And now at issue is the administrative compliance challenges encountered by foreign entities with no physical presence in South Africa because they'll be required to register for VAT. So what we have said is that if that foreign entity is part of the group of companies in South Africa, We will make the registered vendor in South Africa a representative vendor and register on behalf of that foreign supplier. And that registered vendor who is in South Africa will be required to submit the tax returns on behalf of the foreign supplier. This is ease of administrative burden. So we've issued that ruling in that regard. So in view of the fact that the ruling will come to an end, we are proposing to introduce new provision to deal only with those foreign entities that form part of the same group of companies in South Africa. So provided that you are in the part of the same group of companies and another company is registered in South Africa, then you will get the special dispensation because you will be having a representative vendor who will be able to submit the tax returns to SARS. Next slide. The last one on the VAT is the pooling arrangement. Currently, the VAT Act makes provision for the pooling arrangements, and those pooling arrangements are the one contemplated in the Marketing of Agricultural Products Act and the one contemplated in the time sharing or sectional title. So it came to our attention that even though those pooling are contemplated in those various pieces of legislation, however, the Health Professional Council of South Africa, there are regulations that require medical doctors to enter into pooling arrangements based on the manner in which the Health Professional Council regulates the practice of medical practitioners in South Africa. As such, before 2019, SARS issued a ruling in respect of the pooling arrangements that are created due to the policies of Health Professional Council Health Professional Council South Africa. So in view of the fact that the ruling will come to an end on 31 December 2021, what we are proposing in the 2022 draft TLAB is that any pooling arrangements that are necessitated due to the regulation by any professional body in South Africa will fall under these provisions. So this is the end of the VAT. Now we are going to carbon tax. Over to you, Charlene. Thank you.
Good morning, everyone, and thanks, Yanga, very much for that. So broadly, the carbon tax proposals that have been included in Budget 22 is framed in the context of the outcomes from COP26 last year under the Paris Agreement and the requirements for countries to accelerate efforts to reduce emissions, in particular in the energy sector, as well as under the COP negotiations for South Africa submitted its commitments to reduce emissions. So we had put forward our second and third NDC, nationally determined contribution commitments, at the COP meeting last year. This is for the period 2020 to 2025 and then 2026 to 2030. The approach that has been taken for us to reduce our emissions is for emissions to peak in 2025 and then to decline from 2026 onwards. And we expect emissions to decline in the range of around 350 to 420 megatons in 2026. As part of our NDC, the carbon tax is one of the key policy measures that has been put forward. It forms part of the measures, including a system of carbon budgeting, as well as sector emission targets to be implemented by the Department of Environment. Next slide, Chris. This slide just gives an overview of the broader climate policy context in which we are operating in 2022 to help achieve the NDC commitments that we've set out. We're in the process of enacting the climate change bill, which has been published for consultation, and there have been hearings on this bill. As part of the climate bill, the Department of Environment provides for sector targets, carbon budgets to companies, as well as a requirement for companies to develop mitigation plans and set out how they plan to reduce their emissions over the NDC period and beyond. They've also made a commitment or an aspirational commitment to net zero emissions by 2050, and this is also aligned with many other countries globally. Several companies have also made commitments to net zero emissions by 2050. There's a few strategies that have been implemented or in process of being implemented around energy efficiency, green transport. There's a package of measures around tax incentives that are already in place. And to support a just transition, there are initiatives underway through the Just Energy Transition Partnership work to access climate finance, as well as the Green Finance Taxonomy that was published by the National Treasury to promote a transitioning of the financial sector and reduce the risk of stranded assets. So this is the broader climate policy context within which the carbon tax is framed. Next slide, Chris. You can move on. So the carbon tax was introduced in June 2019 after an extensive consultation process. Just to reiterate that the tax seeks to give effect to the polluter pays principle. It aims to internalize the negative externality costs of climate change that are imposed on society and create those incentives for behavior change by firms, consumers across the board towards low carbon, more energy efficient and cleaner technologies. It forms part of the measures to help with our NDC commitments. And in the introduction of the carbon tax, a phased approach was taken to introducing this tax. So instead of starting off at a very high carbon tax rate that fully internalizes the externality costs of climate change, the tax was introduced at a relatively low rate to provide the signal for behavior change with significant tax-free allowances ranging from around 60 to 95% of total greenhouse gas emissions of a particular company. And the intention behind this approach was to provide the space for industries to transition before they face higher taxes going forward. Next slide. So the proposals announced in budget were essentially, firstly, to take into account the COVID pandemic and the slow growth of the country, to extend the first phase revenue recycling measures, which is the energy efficiency tax incentive and the commitment to electricity price neutrality by 3 years to December 2025 to assist companies transition. Beyond this transition period from 2026 onwards, and for the second phase, taking into account the NDC commitments, which are more ambitious from 2026 to 2030, the proposals include ramping up the carbon tax rate over the period 2026 to 2030 and over the longer term, and to strengthen the price signals. This approach was taken to provide policy certainty to companies on the future carbon price path and to guide their longer term planning and investment decisions that's required. Next slide. So as mentioned, for the period 2023 to 2025, the commitment to electricity price neutrality has been extended. So under this commitment, electricity generators as taxpayers can basically offset the payment of their electricity generation levy against their carbon tax liability, and they can also offset any additional purchases of renewable electricity, the costs of this against their tax liability up to December 2025. The energy efficiency savings tax incentive was introduced in, I think it was November 2013, and it was extended at the time of introducing the carbon tax in 2019 for a 3-year period to align with the first phase of the carbon tax, which was supposed to end in December this year. So to further assist companies with the transition, this tax incentive has been increased for a further 3 years until December 2025. We also have in place a carbon budget allowance of 5% that companies can claim under the carbon tax. This was put in place to encourage companies to participate in the voluntary carbon budgeting system of the Department of Environment. This voluntary carbon budget system will come to an end at the end of this year, and the mandatory carbon budgeting system is expected to come into effect from the 1st of January next year. So the carbon budget allowance of 5% will fall away as this mandatory carbon budgeting system comes into effect. We had also announced the penalty for non-compliance with the mandatory carbon budgets. It has not been included in the tax laws amendment bill at the stage. And the main reason for that is because the amendments can only be made to the Carbon Tax Act once the climate change bill is enacted. Next slide, Chris. So for the period 2023 to 2030, and to provide that policy certainty to companies around how the carbon tax rate would change over time and be strengthened, we had proposed in budget for an increase in the carbon tax rate by a minimum of $1 for the period 2023 to 2025, and then increasing to a $20 equivalent, Rand equivalent in 2026, and $30 Rand equivalent in 2030. The proposed amendments in the TLAB seek to give effect to these proposals and a progressive carbon tax rate trajectory. So for the period 2023 to 2025, it is proposed that the rate adjustment is by $1 in 2023, $2 increase in 2024 from the 2023 rate, and a $3 increase in 2025 from the 2024 tax rate. For the period 2026 to 2030, the amendments proposed give effect to the $20 Rand equivalent rate in 2026 and the $30 rate in 2030. And then for the period 2027 to 2029, there's a linear increase in the rate of $2.50 per year is proposed. And as mentioned, this aims to provide the longer-term policy and investor certainty and help to achieve the NDC commitments. Next slide, Chris. This is the last slide. So overall, the proposals for the carbon tax provide for an extension of the first phase revenue recycling measures and extends the transition period to companies to take early action to reduce their emissions and transition to more energy efficient and greener technologies and practices. It takes into account global policy developments through the European Union Carbon Border Adjustment Mechanism that comes into effect next year, but with the actual financial adjustment being made to emissions intensive exports to the EU from 2026. It also takes into account proposals under the G20 and the IMF for minimal global carbon pricing. So going forward, higher carbon prices are unavoidable, and earlier action to mitigate emissions would be required. This also presents a significant opportunity for an increase of new industries, meaningful jobs, and technology innovation in order to promote the competitiveness of our economy. And lastly, action is encouraged, and companies are encouraged to take action to reduce emissions now or face these higher taxes in future. And also this will take into account broader developments around the climate change bill and implementation of the various additional policy measures that are being proposed. Thanks.
The next one is vaping. Over to you, Mpho.
Good morning, Chair, and good morning, honorable members. With regards to vaping, government has signaled an intention to tax electronic nicotine and nicotine delivery system, and that was done in budget 2019. and subsequently in budget 2020. And this was done at the backdrop of the growing presence of these new generation products in the market. And then also that the WHO has urged government to use the tobacco product control regulations at the national level to also cover these new generation products. So since then, National Treasury published a discussion document last year where we had proposed that we apply a specific excise tax based on two components, based on the volume of the e-liquids and also the nicotine concentration on those solutions. But after we have received comments on the discussion paper, we made a revised proposal in the 2022 budget, where we then revised the proposal to a flat excise duty of 290 per milliliter, regardless of the nicotine content of the solution. And the proposed implementation was for January 2023. And the reason we had changed the proposal to a flat rate was that the issues around administration of determining the nicotine content of this product was going to impose quite a significant challenge on the administration of the tax. That's why therefore we made a revision to apply a flat rate regardless of the nicotine content of the solution. And after the consultation with SARS, the decision then was made that we postponed the implementation of the proposal to June 2023 instead of January 2023, and the changes to the schedules I included there in the part that relates to the Customs and Excise Act. Thank you very much.
Thank you. Now we go to the Tax Administration Act. Over to you, Franz.
So thank you, Younger. Good morning, members, and good morning, Honourable Chair. So the first one here relates to the refund of withholding tax under circumstances where the person who receives the withholding tax does not provide a certificate that indicates that they are either exempt from the withholding tax, for example, a pension fund, or they are subject to reduced withholding rates, perhaps because of an international tax treaty. And the situation then is that they need to get a refund because they were late, so the tax was withheld from them. And the way that works is that you would put the certificate in and you would claim the refund from the person who withheld the tax, in this case, a regulated intermediary. And the idea originally was that a regulated intermediary had a wide range of clients, so they would be able to refund this amount from other withholdings that they had collected fairly quickly. Unfortunately, the situation has come to light where there may be a particularly large shareholder and the other shareholders are relatively small, so that it becomes difficult to refund this tax within a reasonable period. And so what is being proposed here is that we switch to a model that we use when it's the company that does the withholding, which is if the refund cannot be made within a year, the regulated intermediary comes to SARS, asks for a refund of the balance, and then is able to refund the company concerned. So moving on to the next slide. We now come to the question of invoices in the customs and excise space. Now, an invoice is a very important document in the customs and excise space, and recently there has been a bit of debate as to just what kind of details are required in an invoice. particularly where we are dealing with goods where there are some challenges around valuation. Members may be aware of some of the difficulties that exist, for example, in the textile space. And so there's been some debate here as to what should be included and what not. And the idea here is to clarify this and then allow the Commissioner to specifically prescribe the particulars that are required for certain classes of invoices, so that we can get the required details we need to make a proper valuation of the goods that are being imported. Next slide. The next one is quite an important one and be very much welcomed by trade. So this proposes the introduction of a framework for providing advanced readings in the customs space. This is something that we've had for a while now in the income tax space and the other taxes. And it is something that is provided for in the World Trade Organization's trade facilitation agreement. Now, the benefits of that, it assists clients, it gives them certainty, and it's something that fits very much within SARS' strategic objectives of providing additional clarity. So that's something that South Africa has committed to implement in terms of its undertakings when it signed up to the trade facilitation agreement. And this then provides for the framework for the implementation of such a system. Next slide. Members will be aware of the provisions that were introduced to require foreign electronic service providers to register in South Africa and pay over VAT on services provided into South Africa. Now, a practical issue that may arise here is that sometimes you have a very short spike or once off that pushes you over the 1 million rand registration threshold, and thereafter you don't do further business in the country. So this wouldn't apply to generally to the larger sort of mass market suppliers, but it may apply to sort of smaller niche suppliers. And there's already something similar to this in the domestic law, where what can happen is you would approach SARS, say, can I please not need to register here because this is a once-off, it's out of the ordinary, and then it just doesn't make sense for you to register, for SARS to take you on register for this once-off transaction that isn't going to be repeated, or this once-off event. So next slide, please. Now, members will also be aware that we have the concept of a registered tax practitioner, and a registered tax practitioner is registered both with SARS and with a recognized controlling body. Now, this is intended to ensure that the practitioner maintains professional standards. It gives an easy avenue of redress for taxpayers. If there are problems, they can go to the recognized controlling body. And there are two kinds of recognized controlling body. The first are the so-called statutory recognized controlling bodies. So those are bodies which exercise control over tax practitioners by way of a statute. And then there are the ones where by application to the commissioner, they can be recognized provided they meet certain criteria. Now, there are two recognized controlling bodies by statute, and they are IRBA and the Legal Practice Council. Now, historically, IRBA used to exercise some control over tax practitioners. They took disciplinary action against auditors who engaged in problematic conduct with respect to tax issues. But more recently, they have focused more clearly on the audit aspect. And so there have been some legislative changes to recognize that greater focus. And so what now happens is IRBA would not look into the tax aspects. They would refer it to their equivalent of a recognized controlling body and a professional body accredited by IRBA. And so IRBA has requested us to remove them from the list of statutory recognized controlling bodies, which is now being proposed. The accredited body that IRBA has at present is the South African Institute of Chartered Accountants. They're also a recognized controlling body for tax practitioners, so there should not be a practical impact with respect to this change, because the members would simply move from one recognized controlling body to another. So the next slide, please. All right. So if you wish to do business with government, and I believe certain larger corporations do this as well, they look for a positive or clear tax compliance status. And what SARS has encountered recently, and this particularly came to light in certain PPE transactions, was that in order to get a clean tax compliance status, a company would simply put in some null returns. So now they have met their requirement to have their returns up to date. Since there was no tax, they were null returns. They also have no tax debts outstanding. And so they tick the procedural boxes to be considered to be tax compliant. The fact of the matter, however, is that you can see some very substantial transactions that these companies are undertaking. And so it's clear that there's a problem here. And so what is being proposed here is that where you have something that is clearly problematic, and we're talking about fraud, misrepresentation, or non-disclosure of material facts, that SARS should be in a position to revoke access to your tax clearance status so that it's not available to be checked. And that would then allow SARS the space to investigate this serious issue that has come to light. Now, we appreciate that that can be problematic for businesses, and there may be issues there that can be resolved. And so that's why there is a requirement that at least 10 business days notice to respond must be granted to the company or the taxpayer before the revocation takes place. That allows the taxpayer to come back to SARS and say, no, you misunderstand the situation. Here's what's really happening. And SARS can then say, okay, we understand there isn't in fact the serious problem that they thought there was. This is very similar to the approach that is used on initial application for a tax clearance status access. The problem, though, is that that's fine for when the application is initially made. The issue arises a little bit later in the process. And that's what this is, the gap that this particular proposal is meant to address. Next slide, please. The other issue that we're picking up is that you have newly formed companies that are spun up. No returns are required at this point. No payments are required at this point. So yes, technically, again, they are tax compliant, but at this stage, nobody knows whether they will or won't be tax compliant. So although we think we could probably do this under existing law, we think it also would be useful to have this properly documented. So the idea here is that SARS would add a statement to the tax compliance status, simply saying this is a newly registered taxpayer. It hasn't yet reached its first date for filing a return or making a payment. And that will allow the user to say, oh, okay, new company, although they have a positive tax clearance status, maybe I need to look at this a little bit more closely just to make sure we're comfortable from our perspective. From a SARS perspective, they clearly still have a positive tax clearance status, but it's just a little bit of a caveat so that the user knows where they stand when they rely on the tax clearance status. Then a sequel to a change that was made last year, members will recall that we ran into some abuse of the employment tax incentive, which was addressed last year, where training contracts, and some of them of rather dubious value, were being dressed up as employment, and then employment tax incentive was being claimed and shared between the training service provider and the employer, with very little benefit for the actual employee or supposed employee. That brought into sharp focus that There is, in fact, no penalty in the Tax Administration Act for doing that. So that is being proposed this year, that we address that and that we permit a penalty to be imposed where reasonable care wasn't taken, or it's simply an abusive set of transactions, just to ensure that there is a degree of consistency across the Acts. And so that's it from my side. Thank you to the honourable members and to the honourable chair, and I'll now hand back to Jan.
Okay, thank you. The last slide on the presentation refers to the proposals which was included in the 2022 budget review, but not included in the 2022 draft TLAB. The reason why we want to put it to Parliament today, because we know that during public hearings, the taxpayers are going to come because they've already written a letter to us asking us why was the amendment not made. So this refers to clarifying the tax treatment of collateral arrangements. In 2021, amendments were proposed in the draft TLAB regarding the abuse of the use of collateral. And the initial effective date on the draft TLAB was 1 January 2022. After receiving public comments, the effective date was changed to 1 January 2023. And then in the budget review, we said that during the 2022 legislative cycle, government will review the impact of the proposal and amendments could be made. So first is the review and then make amendments. So immediately after the budget, we have had many meetings with the affected stakeholders regarding this proposal. And then after those meetings, because we were reviewing, government decided that no further amendments need to be made on the Taxation Laws Amendment Act. And the effective date of 1 January 2023 will continue, and the proposed amendments will continue as they stand. I'm putting this up front because we've already received letters, but I want to clarify that we said we're going to review before making amendments. It was never a done deal that amendments will be made. First, we had to make a review. Thank you, honorable members. That's all.
No, thank you. Thank you, Chair. As Yanga said, after this marathon, almost 2-hour presentation, I'm sorry for torturing honorable members with such gory detail, but that's the nature of the tax system and the process. And thank you, Chair. So over to you, and we're happy to take questions.
Okay, thanks. We are struggling with connectivity. Even the parliamentary server is down. We are using a Gmail here. There are problems there and there. Be that as it may, I'm reconnected. Honorable members, there we are with the presentations. So the commissioner didn't manage to connect here.
No, he's not on, Chair.
Okay. Honorable members, there we are with the presentations. Clarity, seeking questions, comments. Dr. George, over to you.
Thank you, Chairperson. Thanks for the presentation. I know that there's going to be still lots of inputs on this, so I'll just be brief. I want to raise the question on retirement reform, which I think was mentioned that this is obviously one of the big items coming through that's been on the table for a very long time. It seems to me that it's actually a 3-pot system, not a 2-pot system if you look at a vested pot. But anyway, that's just a comment I want to make on that. But more specifically, it makes provision for the withdrawal of a portion of the savings pot. So that's very clear. And what happens when you withdraw money from a pension fund, as we all know, is that you pay tax on that money. And it is removed out of the fund, and you cannot enjoy any growth on it in the future because it's actually been withdrawn. Now, what I want to know, and this has been raised by me previously, that why there cannot be provision for a loan facility on a fund. Now, I have raised it before through a private member's bill, but that bill was fundamentally misunderstood because it was basically understood somehow that it would be a withdrawal from the fund, but it was not. So the point is this. We are looking at a proposal to withdraw from the fund and pay tax on withdrawal, and the money's gone forever out of that pot, right? It will be spent in the economy. Now, I cannot see why there cannot be a provision for a loan facility on the fund that then permits the member to utilize a portion of the fund as a surety for a loan. It's not a withdrawal, a surety for a loan. The loan is then given to the member, obviously determined according to affordability, the National Credit Act, the rules of the fund, etc. And then the member can pay that back, which means then that they do not need to take a withdrawal from the fund. The money remains in the fund, it remains invested, and then they get the benefit of that investment. And they have not taken it out of the fund or paid tax on it. Then the member pays back the loan, possibly on soft terms because it is 100% backed by surety in the fund. Now, I don't think that's a difficult concept to understand. So there is no reason why that facility could not be there. It would not mean that everybody would default. It would not mean that it would put everybody into unaffordable debt because the National Credit Act would still apply. But what it would mean is that members would be able to utilize their own asset as a surety for a loan that they then pay back. Yes, some people would default, that is probably so, but not everybody would. So I cannot see why a facility like that cannot be included in the reform package that is now on the table. Other than that, I want to say it is good to see that there is progress on this matter. Thank you, Chair.
Thanks, Dr. George. Any other member who would like to make a contribution or ask a question? Honorable Abraham, over to you.
No, thank you, Chair. Thank you so much. It's always empowering to listen on an annual basis to Yanga and her team. But I just want to say that I'm also carrying a gadget similar to Yanga's that doesn't show the video. Yanga. I want to talk to the issue of the 5% that can be accessed by companies by way of tax relief. And I just wanted to check whether I hear that it is with the Department of Environmental Affairs. But I would like to check whether Treasury knows that the companies are accessing the 5% and at what rate? Because my question really, Chair, is around whether companies are aware that this is an advantage that they could access if they comply first and foremost and really need that relief. Thank you, Chair.
Thanks, Noxie. Is it possible now that we have a gadget without a camera when we have got iPhone 13? Noxie. Are there more questions?
Not yet, Chair, not yet. I don't have the iPhone yet.
Even my mother has got a phone with a camera, though she doesn't use it. But her phone has a camera.
It's
So
a
just-
protest, Chair. I'm protesting against youngers.
But the camera, phone with the camera, but the grandchildren use it. So I don't believe that there's any gadget without a camera. So that the camera has to be fixed younger. It's a rule of parliament that when we present, we must be visible because they are audio streaming the meeting. Let me go back to Treasury and SARS. Can you please respond to those inputs or questions from the two members?
Yes, no, thank you, Chair and honorable members. And Honorable Abrams will investigate Yanga because, yeah, for 2 years, she says her laptop doesn't allow or gadgets don't allow her to put on her camera. And either she's deliberately sticking to old technology or so, but I think she doesn't want to be visible. But we'll see how we can help her. Now, Honorable Chair, I think Honorable George is correct. He did bring in the private members bill. I think what we tried to signal at that point is there really is a lot of abuse on the when members have been borrowing, and it does have a direct impact, though money is not withdrawn. How the money is treated by funds, whether they can invest it. I think we raised a lot of the technical problems at the time, what happens when there's defaults. And of course, this is allowed under current legislation. It's just that each fund must determine whether it's going to allow it. And generally in our discussions, I think it's really, I mean, like any tool, it may have its positives. We're not saying there's no positives, but on the whole, it really, there's a lot of certainly anecdotal evidence when we've talked to the different funds of abuse and so on. And you will see that under Regulation 28, we've even reduced the percentage going forward. And it's something that I think we even have to review whether we want that mechanism to stay to the extent that it's allowed. We do feel that this mechanism to withdraw from the 1/3 pot, on the whole, is a better option. It's understandable. Yes, people do withdraw, but at least they do preserve the 2/3. And on the whole, I think, and no one knows exactly, but we hope that that will lead to more preservation and not less. And yes, we use the tax, the withdrawal taxes almost as a disincentive. And I did say that, you know, in when you look at pensions, it's one of the classic examples around behavioral theory, is how to prompt people, how to nudge people, not force people, nudge people. Yes, some things you force when you say we have a mandatory contributory system, that's what we want to go to. But it is more about nudging and providing incentives. And, you know, for all those reasons, I think we certainly did not support the approach of expanding on the current loans for retirement funds. Now, again, I mean, I'm not saying that anybody is 100% right or wrong in this. It is a judgment call, but we feel this system is a better option. And even this system will have its pros and its cons. And, you know, we can debate it and see how it evolves and what the incentives and disincentives are. But the bottom line is you almost have to push everyone to really save, most people to save for their retirement. Otherwise, they simply won't. And you want to make sure that you preserve something. And the judgment call we've made is that through this system, at least we should achieve higher rates of preservation. And also, as part of it, if we take the steps to reform and get more mandatory contribution or auto enrollment, that will also get many more people into the net. But again, we can have, you know, no one way is perfect and the only way either. There are other mechanisms, and I would, you know, continue to invite Honorable George, if you would like. We'd be happy to have a technical discussion through this forum, or invite him to the Treasury to discuss the pros and cons, because I'm trying to understand. I know he feels strongly about it, but I must say I haven't got to understand why he feels so strongly, and perhaps he's got arguments that haven't been put up more explicitly. And as I said, there's no one way of doing things, but we're happy to engage on that. Notwithstanding that, I think that clearly, even if we had a loan system, I think that we would need this withdrawal pot. And can I say that it does look like there are some countries also expanding on this two-pot system. Honorable George is right that there is a third pot with all the vested amounts, which you hope, you know, in some way we can even incentivize people to move towards the two pots. But we're obviously not forcing people. We're accepting their rights and then preserving their rights. So that's as far as the loans is concerned. I don't know if Alvina or Basil, you want to come in and add, or Chris or Mvula, Malay. Does anyone want to add from the Treasury side? Okay, so let me move on. I think on the 5%, that relates to the carbon tax. I'll ask Chris or Sharon to come in. Yes, it does have to be coordinated with the Department of Environmental Affairs, Forestry, going forward. And yes, we are aware of it. There's only 100 companies, just your scope 1 companies currently to which the carbon tax applies. I'm not sure we're aware of it directly, but let Sharon come in, or Chris.
Thanks, Momo. Yeah, so currently there's around 370 licensed entities for purposes of the carbon tax with SARS, and about 85% of them are tax compliant. So overall, when you look at the revenues from the carbon tax since its introduction, we've collected just over 2 billion rands. So that indicates that a large proportion of the tax-free allowances have been claimed under the carbon tax, including the carbon budget allowance. So I think we can say that companies are aware of the carbon budget allowance. There's extensive engagements through the Department of Environment on the carbon budgeting system. And there's a process between the Department of Environment and SARS to ensure that companies get the required documentation in order to claim the 5% allowance. Thanks.
Thanks, Sharon, and thanks for correcting me that it's more like 400 companies. But because they're so few, and they tend to be the bigger ones because they really are the big emitters, they tend to know the tax system as it applies to them quite well. And let me say, Chair, I was also noticing overnight there was an article from one of the really big emitters in South Africa, sort of saying that there's no certainty on a particular or these allowances. Generally, climate change does bring great uncertainty to everybody, to the whole world. So we must just have that perspective. And to the extent that we take steps as a world, not just as South Africa, to bring down greenhouse gas emissions and try and achieve the maximum 1.5 degrees Celsius, or to limit it to that degree. To the extent that we don't succeed, and everything suggests that it's going to get tougher and tougher as countries start too late to take steps, that the measures that we're going to have to take as a world will actually get to be much stronger. So the one thing you can be certain is, if we don't succeed now as globally, that it's going to mean that we're going to have to do even more. It's going to be much harder to take steps to mitigate and adapt against climate change. To the extent that we can, from a policy side, we hardly say on any text that for the next 20 years, this is the path. So here we've got a whole path over a number of years of how the carbon tax will be going up. Just to, and obviously, if companies delay in doing something now, the carbon tax is going to be much higher going forward. So we're almost saying you can be certain it's going to go up. To the extent that all the allowances are clear, yes, there might be some uncertainty, but compared to the uncertainty of climate change, I think it pales into, well, it's not really that significant. And some things it's possible to give a lot of clarity, and we do with the carbon tax, but we continually engage with companies, especially as they are talking about green investments, to engage with them and to see how we can facilitate greener investments. So that's just a broad perspective we have. These companies are all very aware of the carbon tax. Most, of course, not surprisingly, oppose the carbon tax because they were emitting, it's going to be more expensive. And yes, it does have an impact on the rest of society, both ways. And it's something that we're just going to have to look at, and it's a dynamic situation. So I'll stop there, Chair, just with regard to the carbon tax and climate change.
Do we have members? Let me check here, Momo and your team. During the time of COVID, when more than 2 million people lost jobs, or they were in financial distress, there was a talk about members of various schemes to have access to their pension savings that they can withdraw. Yet Honorable George is talking about a loan. There was also a talk about a withdrawal of a certain portion of the money which is invested in the pension fund. Is it catered for? Yeah, because I can see that you have issued a statement about what you call a retirement reform and the draft legislation for the two-pot system. What we have been discussing from 2020 in regard to members having a direct access to their pension and withdraw a particular portion. Is this retirement reform catering for that? I can't remember whether you call it Regulation 28 or, but there was a specific regulation that we talked about. And the minister, I think either in his budget speech or MTBBPS, also mentioned this issue, because there was a lot of pressure from many South Africans who were in serious financial distress. Is it catered for, or here we're talking about something else? Thanks.
So, Chair, yes, this is a measure that emerges from the discussions in 2020 when the unions first made this request to us. And yes, it is, Chair, a very, very complex situation because if you, firstly, you had to change the law to allow for such withdrawals. Bear in mind that those who resigned could access it and did access it in many instances, I would imagine. It's just those that, and one of the objectives is we don't want people to resign from their jobs to have access to a small amount of their retirement fund. So this is a direct response for that. It has taken a long time because the issues are really complex. The amount of work and engagements we've had and the concerns we've had to deal with, I think, has resulted in the current product. And in a sense, it's not going to help people now. It's going to help people if there's a similar future crisis, I would add. And to the extent that it does, even after it gets enacted, I think that we are going to get from funds concerns they have about how quickly they can implement because their funds are already invested. So we are concerned about possible liquidity problems or runs. We look at countries like Chile, what happened. Chair, yes, it does try and address that, the concerns or raised when COVID started on access to pension funds or their pension savings by members. But it has taken longer, and we've had to put a lot of restraints because otherwise, people will cash in everything and you will have liquidity problems and it can cause problems. So we've had to take all of those into account. And we think that we've got a model now that can work, and we'll tweak it as we go. And in fact, we are really looking forward to the comments and see how all the various stakeholders see this proposal. And I have no doubt we'll have to make some amendments even now, once we have after we've had the hearings. But it does try and address the 2020 problem raised when COVID started.
Okay, we'll continue to engage before we pass the legislation to make sure that all those issues that were raised are clearly catered for. Any other member who would like to make an input or ask a question? I don't see any member raising a hand in the platform. So let's move to the next item. Before we close, Tebogo Buthe, are there announcements?
We have no announcements except that we're having another meeting tomorrow.
Okay. Okay. No,
I'll be sending the link and all other documentation after this meeting has ended.
Okay. And please talk to IT to get the parliamentary website to be up and running. Okay. Thanks very much, honorable members. Treasury, led by the acting DG, Comrade Momo. SARS, other officials from the National Treasury, the whole parliamentary team, support team present here, other stakeholders who are here in the platform. I've seen others who have, like Saika, who have just logged in, the media, and the public in general. Thanks very much for participating in this meeting. We'll meet again tomorrow. The meeting is adjourned. Thanks.
Thank you very much, Chair.
Thank you very much, Chair.
Baie dankie, enkosi.
Thank you very much, Chairperson.
Thank you.
Long live the chair.
Malibongo.
Recording stopped.